Good morning, students. Today we will be covering the chapter of currency options under the subject International Financial Management for MBA 4th semester, Finance Major and Finance Minor. We have already seen that in the forex market there is currency risk because of fluctuation of the exchange rates. As a result, the companies which are importing, like the oil companies, or companies which are into export service, like IT companies, they are facing the currency risk due to the volatility. So, we have already learned that how forwards and futures are the derivative instruments which can be utilized in order to hedge or minimize the risk that is there. So, today there is another set of derivative instruments which is very important and highly popular in the global forex market that can be used to hedge this risk. So coming to option, actually what is the meaning of an option? An option means that we are a freedom, we are a liberty to do something. These options are actually of two types. Call option, which is an option to buy, and the other is a put option, which is an option to sell something. So let us think in this way. Most of these options are traded in the exchange, like NSE, BSE, MCX. But then what is a call option? There will be two parties, that is a buyer will be there and there will be a seller. The seller is also known as the writer of the option. Under this, what is happening? The buyer agrees to buy something from the seller at an agreed price at an agreed time. The price at which the buyer is agreeing to buy from the seller is known as the strike price or the exercise price, and the price that is currently going on in the market is known as the spot price. Now, because the seller is under an obligation to provide that particular instrument or the forex, it can be commodity, it can be currency, to the buyer at a particular date, the seller will receive a compensation now for that, which is called the premium. Options are highly popular in equity market, where we have index options, we have got stock options. It is there in the currency market where we have got currency options, and nowadays also we are having commodity options on gold, silver and other commodities. Now we'll see how these options instruments are traded and how they are going to help us. First we'll discuss about the call option, which I have already said. Call option is an option to buy, where the buyer enters into an agreement with the seller to buy at an agreed price at an agreed time. The agreed price is called the strike price or the exercise price, and the seller is going to get a premium for that. Now, before we move into the call option further, there are certain terminologies that we need to know. Like, the price that is going on now in the market is known as the spot price. The strike price or the exercise price, which is the agreed price, can be more than the spot price, can be also less than the spot price. Depending on whether it is more than the spot price or less than the spot price, the premium of the option depends. I give a simple example. Let's say, in case of wheat, the spot price of wheat is, let's say, rupees 30 a kg now. Now, the government is thinking that this year the monsoon is going to be very poor in India. As a result, what is going to happen? Because the monsoon is going to be poor, the production of wheat will be impacted. And so the production will be low, and then we will have to import wheat from foreign countries like Canada, Australia and other. So, because we are thinking that the monsoon is going to be low, the prediction is there from the Met, the spot price of wheat will go up because there will be a shortage of supply in the market. So what the government can do now, they can enter into an agreement with these foreign countries like Canada or Australia that we are going to buy wheat from you at, let's say, rupees 33 a kg, which is the strike price or the exercise price at a certain date, let's say 3 months down the line. And as a result, what is happening, the government of India will have to give them a premium. Let's say that premium is rupees 1 per kg. That premium is like an advance which is given. So after 3 months, what may happen? Really, the prediction of the Met is correct. That is, the monsoons are very poor this year. There is a scanty rainfall. As a result, the supply of wheat is falling in the market, and the price of wheat is going up. So the total cost of import of wheat from Canada or Australia is coming at rupees 34 a kg, because 1 rupee we are paying now and we are agreeing to buying at 33. So after 3 months, if the spot price of the wheat becomes more than 34, then the government will exercise this call option, because it is our right to buy, and the seller or the writer, which is the Canadian government or the Australian government, will be giving us the wheat at the agreed price, and then we can supply it into the market. But let's say the monsoon is good and we have a bumper crop production. As a result, there is a good supply of wheat in the market. As a result, what happens? That the price of the wheat in the market goes down. It becomes 28, 29. In that case, we are not going to exercise the option, and as a result, we will end up rupees 1. But in this way, we can protect ourselves against the risk. Now, how to apply this in the case of, let's say, currency option, which is a call option? I will draw a diagram to see how this particular call option is going to help us in case of the currency market for hedging against forex risk, especially applicable for IT export companies, automobile export companies, or companies which are importing, like the oil importing companies or other manufacturing companies which do import from abroad. Let us draw the diagram to see the payoff profile of the call option buyer and the call option seller. So on the left hand side, I am drawing the buyer's diagram, and on the right hand side, I am drawing the seller or the writer's diagram. Now, certain terminologies we will have to know before going into this. I have already discussed that the spot price means the price that is there now in the market. Let us say that the spot price is rupees 75 to the dollar. So if we walk into any bank today, that is a PSU bank or a private bank, and we require dollar, we have to pay 75 rupees to the dollar in order to get the dollar. So that is the spot price. Now we are agreeing to buy the dollar at a rate which is the strike price or the exercise price. So that strike price or the exercise price can be more than this rupees 75, can be less than this rupees 75. So depending on that, we have to know 2-3 terminologies. These are known as in the money option, out of the money option, and at the money option, which are all applicable for both the call option as well as the put option. Now, what is the meaning of in the money option? In the money option means if the spot price is greater than the exercise price or strike price. That means, let's say the spot price of the rupee dollar is now rupees 75, but we enter into an agreement which is an option with the seller that we are going to buy at, let's say, this spot price is greater than the exercise price. So let's say we enter into an agreement with the seller that we are going to buy the option at, let's say, 72 or 73. Then why it is called in the money? Because though the spot price is 75, we can get it from the seller at a lower price, 72 or 73. So naturally it is called in the money. What is the meaning of out of the money? Out of the money means if the spot price is less than the exercise price or the strike price. Here in our example, the spot price is 75. But let's say we are entering into an agreement with the seller to buy at, let's say, 76, 77. So why it is called out of the money? Because if we exercise this option and buy it from the seller, we'll have to pay a higher price, 76 or 77. So it is not economical or beneficial for me now. And that is why it is known as out of the money. And what is at the money? At the money means spot will be equals to exercise price or the strike price. Now naturally in the money, because if I exercise now, I am getting at a lower price. So naturally their premium are very high and they are expensive. But out of the money, the premium is low. So let us take up a particular example to understand this payoff profile of the call option buyer and the call option seller. With an example, given that the spot price today of the rupee dollar is 75. Now, who will be the buyer of call options? Especially the buyers of call options will be the companies which are associated with import. And not only import, these are the companies who want to hedge the risk. There are speculators on the market. The speculators are there who are buying and selling options in order to make profit, and they provide liquidity to the market. So here I am writing the spot price. The spot price is rupees 75 to the dollar. Here the spot price is rupees 75 to the dollar. This is the buyer's diagram, and this is the seller or the writer's diagram. Now, let us consider in this way that this option which is there is out of the money option. So, in out of the money option, what is going to happen? We agree at a strike price, or also known as the exercise price. Let's say it is rupees 77 to the dollar. We agree to buy it from them at rupees 77. So here also the strike price or the exercise price is rupees 77 to the dollar. Now, because the strike price or exercise price is more than the spot, we are not exercising now because it is out of the money. So we are planning to buy the dollar from the seller at rupees 77 after 3 months. And for this we have to give him an advance, which is the premium. Say the premium is rupee 50 paise to the dollar. So when I putting it on this side of the axis, for the seller or the writer, this premium is the gain. In fact, for the seller or the writer, the only gain is the premium in the case of call option. We'll see in case of call option, the profit of the buyer is unlimited and the loss of the seller is also unlimited. The gain of the seller is only limited to the premium. Now, what may happen after 3 months? After 3 months, it may so happen that the Indian currency has depreciated. That is, instead of 75 rupees to the dollar, which is there in the spot market, the exchange rate has depreciated. So now the spot price is rupees 75 to the dollar. But after 3 months, it becomes 80 to the dollar because of various global issues. And that time, the companies which are importing, like oil companies, they will be facing a loss because they have to pay rupees 5 a dollar more. So then this option is going to come handy to them. It will be an advantageous to them. Why so? Let us think in this way, that we are paying the premium of 50 paise. And if we buy from the seller or the writer, then the total cost is coming to 77 rupee 50 paise, because we have agreed to buy at 77 and we have paid a 50 paise premium now. So what happens? Our break-even point is going to be 77.5. I am writing this in short. That is the BEP, the break-even point. Why it is called the break-even point? Because in the spot market, after this 3 months, if the rupee dollar becomes 77.5, I go to the bank, any of the PSU or private bank, I can get the dollar at 77.5. If I buy from that person, the seller or the writer, I have paid him 50 paise upfront as the premium, and I have to pay 77 down the line. So total it is becoming 77.5. But what happens beyond 77.5? If the rupee is becoming 80, as I have written over here, I can still get at 77.5. So it is cheaper for me, economical for me, and that is why I am calling that from here the profit or the gain is starting. Now what about the seller? The seller is happy with the premium, that is 50 paise per dollar that he has obtained. The break-even point is again 77.5. But what happens beyond 77.5? He will start incurring losses. Why losses? Because in the spot market the rupee has become 80 or 81, but he has to honor the contract and he has to give me this dollar at the 77. So how it is advantageous for us, like the companies which are into import, especially oil, because as we know that India imports a lot of oil from the foreign countries. So if the exchange rate, there is a volatility, the rupee depreciates against the dollar, we can still manage this extra amount that is required to be paid by making profit in this market. So in the case of a call option, we can see that the buyer has got unlimited gain but limited loss. Limited loss is only this particular premium amount. And what about the seller? the seller has got only limited gain, which is restricted only to this premium amount, but they have unlimited amount of loss. We can do the same thing with a strike price which is maybe lower than the spot. It can be 72 or 73. Such options are called in the money. That means I can get it immediately at 72 or 73 instead of 75. And naturally, the options are going to be expensive. Because in any option, the premium has got two parts. One is known as the intrinsic value or the economic value of the option. The other is the time value, because there is 2 months, 3 months time in order to honor this particular option. So what is the economic value of an option? The economic value of an option in case of a call option is maximum of the spot minus the exercise price or zero, whichever is higher. As we can see that in case of out of the money option, which in our first example the strike price was 77 and the spot is 75, and naturally in this case the value is becoming zero. So the intrinsic value is zero. So the entire 50 paise that you have paid is because of the time value. But if we select a strike price 72, 73 or 71, the premium will be 4 rupee or 5 rupee. It will be more naturally because the spot minus exercise is becoming positive. So naturally there is going to be a economic value or intrinsic value, and the remaining component is going to be the time value. So for hedgers, those who want to hedge against systematic risk in the market, those who are speculators, those who feel that the currency will depreciate in the long run, they can buy options now and they can make profit. These options are available on the exchange in our lot size, and that lot size is actually $1,000. But actually what happens in the case of option is, if we buy an option at a particular premium now, which is rupee 50 paise per dollar, and naturally the spot is depreciating, the rupee is becoming much more cheaper compared to the dollar, the premium will go up because the difference between the spot and the exercise is increasing. And as the premium is going up, we will square off as a buyer, because maybe we are not requiring the dollar. We are a trader, we are a speculator. So we are paying 50 paise premium upfront now. When the rupee dollar spot is becoming 80 or 81, as in this example, this gap between this exercise price and the spot is increasing because our exercise price is 77, so it is already 3 rupee difference. So this premium only will be quoting at 3 rupee, 4 rupee. We have only paid 50 paise, we will sell off and make the profit. So actually that way the option traders make the profit. The second type of option that is there, which is very beneficial for companies which are into export business like gems and jewelry, IT companies, is the put option. So from the call option, we are moving into the second set of options which are known as the put option. Now what is a put option? Put option is an option to sell. The call option is an option to buy. In the put option also there will be two participants. That is, the buyer is going to be there and the seller is going to be there. But how the agreement is made, that we first see, and then we will take up this example with currency options. That means in the case of a put option is an option to sell. Option to sell a particular instrument, which can be a commodity, it can be a currency, it can be equity. So here also a buyer is there and the seller or the writer of the put option is there. Now what is happening in this agreement? The buyer is paying the premium to the seller, and in turn he is getting a right. And what is that right? It is the right to sell something to the seller. That is, he can sell. He is buying this right from the seller or the writer, that if I exercise this right, if I sell something to you, you will have to buy it from me. That is the agreement in case of a put option. That is why it is known as an option to sell. So buyer has a freedom, buyer has a liberty. He is only paying the premium. He can sell in the market, or he can exercise this option and sell it to the seller or the writer who is selling the right to the buyer, the option to sell. So let us take up a concrete example first in the case of a commodity and then with a currency. That same example I'd like to say, let's say a farmer who is harvesting wheat. Now we know that the spot price of wheat is, let's say, rupees 30 a kg, and the farmer is feeling that there is going to be a bumper crop production this time due to good monsoon, and as a result, after 3 months, the spot price of the wheat is going to go down to, let's say, rupees 26 a kg. So he wants to hedge against this risk. What he can do now, he can enter into an agreement with this seller or writer by paying, let's say, a premium of rupee 1 per kg, that I am going to sell wheat to you once wheat is harvested after 3 months at an agreed price. What is that price? That price can be more than the spot price, it can be less than the spot price. So he agrees to sell, let's say, at rupees 29 a kg. He is now paying rupee 1 as premium and he is going to receive rupees 29 a kg. So total gain for the buyer is actually rupees 28 per kg, which is receiving as a way of revenue by selling the wheat. So what happens after 3 months? The harvest is there, and due to good harvest, the price of the wheat in the spot market falls to rupees 26. In that case, the buyer of the option, who is the buyer of this put option? The buyer of this put option is the wheat farmer. He will exercise this option on the seller, and the seller will have to buy wheat from him at rupees 29. So how is he protected? If he had to sell wheat in the market, he would have got only rupees 26. But because of this agreement, he has paid rupee 1 now as premium, and he will be receiving rupees 29. But if the opposite happens, opposite is that the price of the wheat increases in the market. So he will sell in the market, he will not sell it to the seller, because the buyer of the option has a freedom or liberty to exercise the option, but the seller does not have that freedom. Seller is bound to honor the obligation. So he will sell in the spot market at 30, 32, whatever may be the price, and he will end up losing only rupees 1 per kg. Just like the call option, here also in the put option, we have to know certain terminologies. These terminologies are like in the money option, out of the money option, and at the money option. These sets are just opposite of what we have discussed in the case of the call option. So here also there will be in the money option, ITM, in the money, out of the money option, OTM, and at the money option, ATM. Now these definitions of out of the money, in the money, or at the money depends upon the value of the spot compared to the strike price or the exercise price, and this set is just opposite compared to that of the call option. So let us take up an example to see this particular payoff profile of the option buyer and option seller in case of a put option. So like the previous diagram, on the left hand side I am drawing the payoff profile of the put option buyer, who is buying the option by giving the premium to the seller or the writer. And on the right hand side of the board I am drawing the diagram of the seller or the writer of the put option. So again, let us take up an example that the spot price of the rupee dollar, as we are now seeing in the market, is rupees 75. Rupees 75 to the dollar. So this is the spot price. If we go to any bank today and we sell the dollar, we are going to get rupees 70. In the banks, of course, there are two sets of rate. One is the bid rate, which is the buying rate, and the other is the ask rate or the offer rate, which is the selling rate. So if we go to the bank to buy forex, we'll have to look into their selling rate, because the bid rate or the buyer's rate is the rate which we need to know when we are the seller, and the ask rate or the offer rate is the seller's rate which we need to know when we are the buyer. So whenever you are buying foreign exchange from a bank, we need to know the ask rate or offer rate. And whenever we have to sell foreign exchange, we'll have to know the bid rate or the ask rate. So there is a bid-ask spread, there is a difference, and that is how the banks keep a profit, because the bid rate is lower than the ask rate. So the 75 is the spot price to the dollar. Now, an Indian company which is exporting IT services to US clients or a gem and jewelry export company which is exporting the jewelry abroad, they have a analysis that due to robust economic growth in India or the steps taken by the government, the exports are going to go up and we'll have more export earning and the rupee will appreciate against the dollar. The meaning that the rupee is going to appreciate against the dollar is, today the spot price in the month of March is rupees 75 to the dollar. But because of higher inflow of foreign exchange or due to the policies of the government, the Indian rupee after 3 months, the spot price will appreciate to rupees 72 to the dollar. So there is a 3 rupee difference. Now think in this way, that an IT company has got a contract that they will provide service of $10,000 to the US client. So if they had converted at the spot rate now at 75, they would have received rupees 7,50,000. But because the rupee has appreciated compared to the dollar, after 3 months, when they want to convert the same dollar into rupee, they are only getting rupees 7,20,000. So they are looking at a difference of 30,000 loss of earning. They are getting fixed amount of dollar, but because the exchange has appreciated compared to the US dollar, so their earnings are becoming 30,000 rupees less. So how this can be compensated? So this particular put option is going to help us to compensate for this particular loss of earning because of the appreciation of the Indian rupee compared to the dollar because of the steps taken by the government. So here we have the spot price of the rupee dollar in both the cases for the buyer and the seller. Again, in this case, the buyer of the put option can go for in the money option. In the money options are always expensive because they have a intrinsic or economic value and they also have a time value. Or they can go for out of the money options which are relatively inexpensive, because in case of out of the money options, the premium component only comprises of the time value because the economic value or the intrinsic value is not there. So let us see how this particular put option will help the IT export companies or other export companies, like let's say automobile export companies, jewelry export companies, or also those who want to trade in this particular market to make profit or compensate against this risk, which was 30,000 rupees shortfall in earnings because of the exchange rate. So in this case, we take a different example. That let us think in this way, that we agree to sell the dollar because our put option is an option where we are buying the right. We are having the right to sell to the seller or the writer, and the seller or the writer has to honor the contract. So I am considering an example that the strike price or the exercise price at which we are agreeing to buy, that particular agreement that we are making is actually rupees 73. So here also I am putting the strike price or the exercise price, which is rupees 73 now. So this option is what type of option? If we go by the definition of the in the money, out of the money, or at the money option, if we sell now, we'll only be getting rupees 73. So we'll sell in the market because we are getting 75. So these are out of the money option. If I had taken another example, that is instead of keeping this as 73, I put the strike price or exercise price as 76 or 77, then I can sell at a higher price. So let's say the premium over here is rupee 1. So this premium rupee 1 is the gain of the seller and it is my loss. Now what happens? Let us see the diagram of this. Because I have paid rupee 1 is my loss. And really the Indian rupee appreciates and it becomes, let's say, 72. So I am getting 73 by selling the dollar and I have already paid rupee 1 as premium. So my break-even point is rupees 72. But what happens beyond 72? As the rupee is becoming 70 or 71 due to appreciation of the rupee compared to the dollar, I'll still get the gain. Why? Because I'm getting 73 from him and I paid rupee 1 as premium. So limited gain. And what about this particular seller? In the case of the seller's diagram, he is getting rupee 1 premium. The break-even point is 72. So beyond 72, he has to buy the dollar from me at that agreed price. What is the agreed price? 73. So he's giving me 73, he's getting 1 rupee, so 72. So even in the market, he could have got at 70 or 69. He's not being able to, because he has to honor the contract, because he has sold me the right that I can sell something to him, sell the dollar to him. So he has to buy at 73. So you will start looking at the losses. Now how does it help? As I just now mentioned, that the spot price we are looking at was now 75, and we are at $10,000 export consignment. So we are getting 7,50,000. But after some months, this is becoming 72. So we will be only getting 7,20,000. So we are looking at a 30,000 rupees loss due to the appreciation of the rupee. But this one is going to help, because I have only paid rupee 1 a dollar. And now, once it is becoming 72, then I can, or even lower, let's say 70 or 71, I'll exercise the option and I'll look at the gain. The rupee becomes 70. So I can still sell at the agreed price, which is 73, and clock again. So let's say the rupee falls to 70. I can still sell at 73 and I'm looking at a 3 rupee gain. But I paid 1 rupee premium. So deducting that 1 rupee, I'm having a 2 rupee gain on this $10,000, where I can gain 20,000. So this is how the options will help us in hedging the risk. And also those who want to trade, like those speculators who are there, they can also exercise these, use these options in order to trade on the volatility of the rupee. So the set of instruments which are there in order to hedge against the currency risk, we have forwards, which are of course OTC, over the counter market. We have currency futures, rupee to the dollar, euro, pound, sterling and yen, which can be purchased and sold also to hedge against the currency risk. And we have got options, which are there, both call option, option to buy, and put option, option to sell, which can be used in order to hedge against the currency risk. And they are highly popular instruments which are exchange traded, and so naturally there is no default risk or credit risk which is there. And they are being used not only by the companies but being used by traders, by speculators in the market in order to earn a profit. But the primary purpose of these derivative instruments, why we call it a derivative, because the price is derived, is to hedge against these risks.